Kia ora, and welcome to the CoreLogic Property Market Update for Whiringa Ārangi 2022. As we move through spring and into summer, we'd typically expect the housing market in Aotearoa, New Zealand to enjoy greater prospects than we're currently seeing. But expectations of further interest rate increases appear to be weighing on the market. Property values fell by a further 1.3% in October, which was a slight improvement on September's result of a 1.5% fall. However, the quarterly change of negative 4.5% now exceeds the worst quarter recorded during the global financial crisis in August 2008. Wellington continues to stand out as the worst performing main centre. Values across the wider capital area fell by 2.6% over the month, with the annual change of negative 13.1% breaking the previous record set only 1 month earlier. Meanwhile, the weakness across the other main centres in Te Ika Maui is relatively consistent, but there were signs of improvement on Te Waipounamu, with only a minor fall in Ōtautahi and no change in Ōtepoti. Still, this downturn has further to run, with the pathway out likely to be determined by the future of interest rates. After all, mortgage affordability is one of the key constraints on the market right now. And the higher the official cash rate goes, and with it mortgage interest rates, the less would-be property buyers can borrow. As is so often the case, all eyes will be on the Reserve Bank and its Monetary Policy Committee, set to release the latest decision for the OCR, alongside their 3-monthly update to economic forecasts, including GDP, inflation, the OCR, and house prices. There's almost a market-wide consensus the OCR will increase 75 basis points to 4.25%, with a decent chance it's followed up by another 75 basis point lift in February. An OCR of 5% could mean a floating rate of around 8%, a 1-year fixed rate approaching 7%, and perhaps more prohibitively, a test rate around 9%. Fair to say demand will continue to be constrained at those levels. For prospective first home buyers, falling values are welcomed, especially when combined with adjusted expectations on property type and location, to hopefully balance out those increased mortgage repayments. Indeed, their share of recent purchases has increased as other buyers, particularly investors, may be struggling more with growing costs and stalling rents. Our recent first home buyer report showed the proportion of first home buyers relative to the rest of the market recently improved, increasing from 23% over the first half of 2022 to closer to 24% in the third quarter. First home buyers appear to have found value where other buyers haven't, and are prepared to make a purchase even if house prices haven't fully found the floor just yet. A long-term outlook is very much important here, with the security that comes with owning your home also no doubt a continued motivation. Interest rates and tightening monetary policy will continue to dominate many Kiwis' thoughts and discussions before the year is out. So it feels appropriate to close out considering the Reserve Bank's difficult position of fighting inflation while needing to protect our financial stability. For now, inflation is the number one enemy, and all tools are geared to get on top of it. But come the new year, greater consideration for a slowing economy, loosening labour market and struggling property market will need to be given. That said, given they've recently publicly acknowledged this cycle of rising interest rates was too slow to get going, they may be reluctant to sound the all clear on inflation until it's well and truly beaten. Meanwhile, in its latest financial stability report, the Reserve Bank also rightly pointed out the housing market challenges, such as the rising risk of negative equity and the potential for existing borrowers to reprice onto a mortgage rate that's actually higher than what they were originally tested at in terms of serviceability. But they also reiterated a view we share, that for as long as unemployment stays low, this downturn should be controlled rather than a collapse. The odds of formal caps on debt-to-income ratios also seem to be firming up, potentially with a flat limit of 7 regardless of borrower type, speed limits for higher DTI lending, and also exemptions for new builds. Early 2024 seems to be the likely timing for this. So much to happen before then though, so make sure you're tuned into CoreLogic NZ on LinkedIn, Twitter, Facebook and Instagram, and subscribe to the New Zealand Property Market Podcast, released every Monday afternoon. Mā te wā.